Right, good afternoon, everyone. Thank you for your interest in financials, something a little bit different. Just a little bit about Polar before I start on talking about the sector. Polar is probably not well known to many of you. It's a small boutique asset manager, run about 12 billion sterling under management. Business was set up in 2001 by some ex-Henderson fund managers who were concerned, to the point of one of your previous speakers, about capacity. They wanted to run money without having the constraints of having to take in money when it wasn't the right time in the cycle. So to us, unless we deliver good performance to you, there's no point buying our funds, and you should go out and buy an ETF. So, financials. So one of the teams in Polar, we run healthcare, technology, different geographic regions. The team that looks at financials, there's 8 of us. The youngest is 30. The oldest is 72, so I've still got 25 years to go before I can retire. These are the 5 financial funds we run, and this is the outperformance we've had since the inception of these funds. And the reason behind that is stock picking. We're individual stock pickers. We're not asset allocator specialists. You know, this is a sector-focused fund. So across these funds, we've been trying to find the best banks, the best insurance companies, and so forth, and deliver that performance. Today I'm going to talk about the Polar Capital Global Financials Trust. So similar to what Katie was saying, it's an investment trust, and we launched this in 2013 as a lower risk way for investors to play the recovery in financials. So we had investors coming to us saying, weren't sure whether to buy Lloyds, buy Royal Bank of Scotland. Can you launch an investment trust that does that for you? So what are you buying? You're buying basically what's predominantly a banks fund, 65% in banks. There's other investments in there, insurance, in asset managers and so forth, but some of the names will be very familiar. One of our largest holdings, JP Morgan, I recommend it. We have Atom Bank, startup digital bank in the UK, some of you might come across. It's a savings platform and mortgage bank at the moment. Nationwide, you'll know. Direct Line we own. So obviously those are some of the ones you know, and others obviously less so. So we launched in 2013, market cap around 300 million. It's an income and growth vehicle, so we're providing a yield of just under 3%, and that dividend has grown by about 6% per annum since we launched the trust in 2013. As Katie was talking, the ability, you have revenue reserves that you can build up to pay out on a rainy day. We have a little bit of gearing there, obviously, to try and juice up the returns, but currently it's about 3 or 4%, so quite small. And we do have an unquoted investment in Atom Bank, which I'm happy to talk about to people obviously post this during the coffee break. Critically, how have we done? Why should you buy us? Well, the only reason to buy us is if we're going to deliver good performance to you. So total return, just close to 72%. Our benchmark there, we use the MSCI World Financials plus real estate, so we've done better. Peer group of funds, so there's a number of competitors out there, not just ourselves, that run unit trusts investing in financials, so we've beaten the average. And critically for us, when we launched the trust, what was the alternative if you're looking at UK banks? You know the history, you've seen the news, it's been a pretty sorry bunch, whether it's PPI, and other conduct issues, as well as obviously what's happened to the UK economy. So why buy financials? It is something a bit different. It's out of favour. It's an unloved sector. And to our sense, that's the opportunity because people don't want to invest in it to the same degree because of what's happened during the financial crisis and since. And the reason here is just some of the key points, and I'll go through some of them. Interest rates, tax reform, regulation. Have we reached peak regulation post-financial crisis? Capital returns. So there's actually a lot of a great flow of dividends and buybacks coming through from some of the stocks that we hold. And I'll touch on risk critically, and obviously valuations. So what I'm trying to highlight here is the sensitivity. So some of the numbers haven't quite worked there, to higher interest rates. When you think about how a bank makes money, it's the difference between what it charges on loans and mortgages and what it pays out on deposits and savings, so that what they call the net interest margin. in a low interest rate environment, as the chart on the right-hand says, as margins have come down, that's been a headwind for profitability for the banking sector. Now, as interest rates go up, the opposite has happened. So as interest rates have been rising in the US, margins have expanded, and that's been to the benefit of earnings and therefore share prices. If you believe that this abnormal world we're sitting in at the moment is going to be different in 3, 4, 5 years' time, and interest rates go back to some degree of normal level, then banks should benefit on the back of that. Some of the European banks and Japanese banks particularly so. We're not predicting interest rates going up in Europe or Japan in the very short term, but when or if they do, then the sector is going to see significant increase in its earnings. Now, just to touch on capital. To us, when you look at financials, it's all about balance sheet risk. You don't have to be very old to remember, obviously, the financial crisis. And there was 2 key issues there. Banks had no underwriting controls when they were lending money, and they had a lack of liquidity and a lack of capital. And I'll touch on all those 3 points. What's happened post-crisis is banks globally have been forced to raise significantly more capital. So they have a multiple. In the US now, you have to go back to the 1930s to a period when banks had as much capital as they do today. Europe, probably the 1990s. But what the 2 charts here are highlighting is just that increase. So that's been a significant headwind for the sector. Liquidity, we don't touch it on here, but you think of Northern Rock, you think of the queues outside branches. The reason Northern Rock came to a juddering halt, it didn't have sufficient liquidity. That's changed materially. Post-financial crisis, banks have to hold a lot more liquid assets, treasuries, gilts, other cash, and so forth. And I'll touch on underwriting in a little bit. Now, the flip side is we're in this sort of abnormal, sort of long cycles, slow, anemic recovery from obviously the financial crisis. Is growth is slow. Because growth is slow, banks and other financials don't need to retain as much money to underwrite new loans. So what they're doing is they're returning it to shareholders more and more each year through buybacks and dividends. And so what we're trying to highlight here on the right is that payout ratios have continued to rise, and this is why you've seen a very strong growth in dividends. Similarly, in Europe on the left, you can see the sector's one of the highest within the universe, and that's the attraction. Now touching on risk. Risk has materially changed within the system. It hasn't gone away. You've got to remember, banks and insurance are risk businesses. They're underwriting. So whether someone's underwriting an insurance policy, they're trying to estimate the likelihood of your house being burgled or floods or whatever it is, or whether it's a bank lending on a loan, the likelihood of you not being able to pay back that loan. Banks are lending a much stricter criteria than they used to. Some of that is driven by regulation. So you think in the UK, you think mortgage market regulation of buy-to-let. And a lot more risk has been shifted off banks' balance sheets into what they call sort of the shadow banking sector or non-bank lenders, because banks aren't allowed to underwrite some of the loans that they did pre-crisis. So the attraction of the sector today is you're buying a sector that's got much better capital, much more liquidity, is much better at underwriting risk, and therefore is a much more attractive proposition. In fact, what we want is they're becoming, albeit they're still economically sensitive businesses, they're becoming more utility-like. You want them to go back to those days where they were a bit dull, albeit cyclical businesses paying attractive yields of 5, 6% or plus in Europe, and similarly good yields in the US, albeit lower. Now the test of does the market believe that is what we put here, hopefully, as a simple chart, credit spreads. So the riskiest part of a bank structure is something called a CoCo or AT1, and the yields on these things have collapsed. So if you believe the arbiter of risk is the credit markets, they're saying the sector is significantly less risky. And this rather complicated on the chart on the right that some of you probably can't see, is as credit spreads have narrowed, and it's the inverse, they've rallied, the sector hasn't rallied with it. So the market's not giving the sector the benefit of the doubt. Now, that's probably pretty fair. Until we go through a recession and banks are tested, then we don't really know how they're going to perform. But we think they'll surprise and actually do a lot better. It's not to say there aren't bad lenders out there, and I'm happy to talk about those. Co-op Bank obviously being one of the ones closer to home, albeit that's not necessarily underwriting. That was corporate governance. A bit of a complicated chart, but valuation. However you look at it, the sector's very cheap. It's always been cheap. It's traded on a discount to the market, but it's derated significantly post-financial crisis. And what we've tried to highlight here, there's periods when it's improved in valuation and people turn more positive. But remember, when you're buying exposure to financials banks, they are effectively the economy that you're buying. If banks aren't performing well, then equities generally probably won't be performing well. So the interesting thing at the moment, partly to do with perhaps some Italian risk, is banks have underperformed. They performed a bit poorly in the last month or so, and the market's carried on going up. So there's a little bit of a disconnect there, but they are very, very cheap. It's not all about interest rates. I mean, short term, that's probably the bigger driver. If you think interest rates are going to go up, that's good for the sector, and vice versa. There's actually a lot more going on that prevents some interesting opportunities. So merger and acquisition activity. There's still 5,000 banks in the US. When you think of the UK, you think 4 or 5 banks dominate the UK banking sector. Until 1992, 1993, a US bank couldn't operate outside its state. So it wasn't until then you started to see a consolidation in the US banks. We think that's going to pick up markedly over the next couple of years. Two particular drivers. One, there's been a change in the administration in the US that is more pro-business friendly. So the whole too big to fail issue has obviously prevented some mergers going ahead. But in an environment where banks are making a lot of money and on the back of US tax reform, obviously earnings have been boosted, margins are going up. Why would you want to sell your bank if you're a CEO of a US bank? When that starts to roll over, that will provide a boost. The second thing, which I'll come on to technology, is obviously what's going on with Fintech and Digitization. So you're obviously all very aware, people use their mobile phones online to bank much more. People aren't going into bank branches to the same extent as previously. So you're seeing banks reduce the number of bank branches. JP Morgan, I believe, tell me if I'm wrong, Bank of America and Wells Fargo each spend the order of $10 billion a year on technology. You could say they've obviously got a problem if they're having to spend $10 billion on technology. But that makes it incredibly hard for others to compete. Think of those other 4,997 US banks. You cannot possibly compete against that. Yes, there'll be some small digital fintech startups that do well, focus on one area. So there's at some point there's a big potential for a lot of banks to think they've got to get together and obviously spend more on technology to hope to compete with the likes of JP Morgan and Bank of America. The other interesting thing is obviously the threat. So it's an opportunity and a threat. People have been very worried, particularly over here, about the threat to the sector from open banking, what's called open banking PSD2. I will not try and put you to sleep at the moment by telling you what that is, but I'm happy to talk about it later. But it's the ability for banks having to open up their system to fintech competitors. The flippant response to this is people get divorced more often than they change their bank account. So it's very, very hard for startups to acquire customers. We've seen this with Atom Bank, where we have a shareholding. And the attraction to VC startups is, okay, if I can partner with a bank, immediately I have access to 2, 3, 4, 5 million customers, and I've monetized that opportunity. So there's a lot I can talk about here. We own MasterCard in the trust, which, as you all know very well, didn't suffer downtime as Visa did the other day, but we do actually like Visa, though we don't own it. Finally, it's not all about fintech, interest rates, small banks. Any, obviously, industry, you have small banks growing much faster. Some of these might be known to you in the UK. Their focus might be more on buy-to-let or asset finance. There's been a lot of M&A recently. We owned Aldermore in our trust, which got taken out. But you can see the potential for much faster growth, albeit you've got to be cognizant of how that growth is being achieved from a risk perspective. And I'll give a couple of examples later. Emerging markets, again, structurally long term. So one of the reasons that people are bearish on the global economy is, there's this debt bubble, household debt, government debt, and so forth. Well, the penetration of debt to GDP, emerging markets is materially lower. So long term, there's the potential here for much faster growth as financial services penetrate more into the market. And then finally, just a little bit on the portfolio, just give a little bit of colour, and I'll just touch on one or two examples. As I said, our favourite stock at the top, JP Morgan. We like US banks at the moment for all the reasons. The economy is performing well. They've had tax cuts, interest rates are going up. But this is a global fund. There's, it's 20% of the market. It's an area that institutions, certainly, you can as private individuals, but institutions cannot ignore. They have to have a view. So you get swings in sentiment, and this is where the opportunity is to find really interesting stocks to invest in. Banks is our largest area, insurance and other areas. We have some real estate and cash there. I'll give a couple of examples here, but I'll just touch on two before I wrap up. So again, going back to their story about US banks, 5,000 banks. These are two Californian banks we own, and you think of California, it's a fast-growing state, Silicon Valley. It's growing much faster than some of the Rust Bucket states in the Northeast. SVB, otherwise known as Silicon Valley Bank, is basically a hub for tech VC startups in Silicon Valley. They have a market monopoly in that area and is growing at an extraordinary rate and benefits from obviously that connection with the tech world. And on Pacific Premier, just another Californian bank that we mentioned there, done some acquisitions, which is why its loans have grown very fast. So just to summarize, why do we like financials? They're desperately cheap. Yes, they're cyclical. So if you're positive on the outlook for markets and you believe there's further to go, the sector should do well. It's an interesting opportunity at the moment. You've got a free option on interest rates going up, and they'll benefit from that because they're out of favour. Balance sheets are much, much stronger. You're getting paid while you wait through buybacks and dividends. And, we think that's a great and interesting opportunity. So thank you very much for your interest. And we're obviously outside, happy to take any questions. Thank you. Thank you very much.